Welcome everyone to the Insurance Asset Risk Asia Forum, an event that brings together insurers, asset managers, and thought leaders to explore the latest trends and opportunities in insurance asset management. I'm Yvonne Lau, a senior reporter with Insurance Asia News here in Hong Kong. This afternoon, we have an exclusive Q&A with Chun-yen Liu, Chief Investment Officer of AIA Singapore, where we'll be focusing on Singapore's risk-based capital regime and how insurers can successfully navigate these new requirements. So Chun-yen, may I ask you, for those unfamiliar with the jurisdiction, could you please give a brief overview of the Singapore's RBC2 regime?
Sure. Thanks, Yvonne. Thanks for having me on the Q&A session. Very happy to be here to share the experiences in Singapore and from AIA Singapore. So AIA, we are in Singapore in terms of our capital regime. Actually, there was RBC1 and then 1.5, now it's RBC2, which is effective in 2021 this year. So RBC2 is a framework that we are reflecting asset values and liability values on the market value basis. So in terms of asset values by asset classes, everything is marked to market. For liabilities, the government does have the methodology of extrapolating a discounting yield curve for insurance companies to discount the liabilities. The yield curve is very much reflecting the current market situation. So it's very much a market yield curve concept. It's very similar to Solvency II in Europe. We also have ultimate forward rate, whereby the yield curve is extrapolating to very long term. We'll be using the ultimate forward rates, similar to the Solvency II regime. So in other words, asset liabilities are discounted on mark-to-market basis to reflect market values of the balance sheet.
Mm-hmm. And for AIA in Singapore, how has the company managed these requirements internally?
Sure. I think that's one thing that's very good in Singapore is that the regulators, i.e. MAS, they did give us a lot of time to basically digest all the new technical specifications of RBC 2.0. It took about a year for the whole industry to digest the regulations and provide interactive feedbacks with our regulators. So that interaction in the consultation process was very helpful. So it sort of gave us a heads up of what's coming. And of course, along the way, regulators were taking our feedback and fine-tune the technical specification. So in terms of time to manage the transition, we had at least a year, if not counting all the consultation process. And also we had time to parallel run internally. So when the RBC2 finally came to effect this year in 2021, we had at least 1 year of parallel run calculation already. So we always know our positions under RBC 1.5 and under RBC 2. I think a key thing to manage very large transfer or transformation in terms of capital regime is the internal collaboration. So I think it's important to work with all the relevant functions. So actuarial team, of course, is leading the whole effort with investment, my function, finance, risk and compliance function, all these functions to come together to really understand the dynamics, the trade-offs, and also have very frequent dialogue as to how market situations affect the capital position, because RBC2 in Singapore is very much highly correlated with the capital market movements. So the key thing is have the time to transition into RBC2 and also very close collaboration among field departments. And it's an educational process to understand the dynamics. And under all the market situations, it's very, very important to review the capital positions frequently. We don't have to have precise capital calculation on a daily basis, but to understand the dynamics and have a very quick way of estimation of the capital ratio on a very frequent basis is very important.
Thanks very much for those key points, Chun-yen. I guess, what are the challenges faced by insurance companies implementing RBC?
That's a very good question. So I think life doesn't stop at RBC2. There's always possibility of further improvement of the regulation. I think the challenges faced in this industry are common challenges faced by all the lifers in Singapore. We do have a life insurance association whereby all the lifers come together and discuss the challenges we're facing. More or less everyone's facing some common challenges. I think one thing, first thing would be what we call here matching adjustment. This is also a Solvency II concept, meaning that if you have the assets supporting the liabilities closely matched in terms of the risk profile, in terms of the cash flow pattern, then you can get relief on the capital charges for that particular book of business. The matching adjustment calculation is massive. It also requires a lot of interaction with our regulators in terms of how to interpret the calculation. So that is a very massive exercise. I think the challenge faced is that there's still some prescribed way of applying matching adjustment. I think this requires further discussion with the regulators if we can further fine-tune the criteria eligible for matching adjustment. That will help our balance sheet to be a more, I would say, a fair reflection of the real risks, residual risks faced by our balance sheet. That's one area of challenge and also requires further improvement. And I think definitely further discussion with the regulators to see how we fine-tune some of the criteria. I think the other challenge we're facing definitely is matching the long duration of our liabilities. Life insurance companies' liabilities can go up to 100 years if we are issuing a whole life policy for babies. So the cash flow can be up to 99 years or even over 100 years, depending on the life expectancy. So to have assets that supports that long duration of the commitment we have to pay 100 years from today, we don't have anything that's 100 years lifetime assets. So it remains to be a challenge to manage that mismatch in terms of assets and liabilities, for that duration mismatch, for the cash flow mismatch, remains a challenge. I think the last piece I would probably share is the some of the new developments in the capital market, such as structured credit assets. In that area, the regulation currently is still quite high level. A lot of things depends on how we interpret the regulation. If anything is not prescribed in the current RBC2, there's a need to engage our auditors and engage our regulator together. So that back and forth also can take a lot of everyone's time and effort. So I think as capital market becomes more sophisticated, we are hoping that we can work with our regulators to further clarify some of the treatments, capital treatments for structured credit products. I think that would be very helpful because as interest rate level, even though slightly going up, it still remains a challenge for us to buy long-dated bonds, to buy corporate issuances with satisfying returns. So inevitably, insurance companies will gradually get into a more permutation of the corporate bond structure, i.e. structured credit, even private credit assets. So that's an area whereby now it's still not very, very prescribed and still requires a lot of clarification with regulators. So I think that's a challenge there. It's a common practice that we always engage regulators before we get into certain asset classes. But if it's a slightly more clarity from regulators how to treat certain structured products, then we don't have to have this engagement process, which can take up a lot of everyone's time.
And I suppose understanding these challenges that you just outlined, in your opinion, what do you think are some improvements that can be made to this RBC regime?
Sure. The challenges I just mentioned, actually there's one more on top of that. I think the area, if I can rank them, I think main area for improvements will be the use of derivatives. As I mentioned, RBC2 the principle is to have a fair valuation of assets and liabilities. And because liabilities are very long dated, we as lifers, we sometimes will engage derivatives to manage certain residual risks, such as interest rates, credits, or equity risks. As it stands now, RBC2, there are predefined treatment for derivatives, only very, very limited to certain usage, the purpose of use of derivatives, the type of derivatives. Other than those prescribed ones, any other use of derivatives, we have to engage our regulators to clarify further. So it's more of presenting them with the derivatives program we have, even though for hedging residual risks. And then we'll go into details as to how we intend to execute the program. And that's, again, a lot of discussion could happen there, which is fine. I mean, we have been doing that, not just AIA, a lot of lifers were doing that with the regulator. But I think that area, since there has been a lot of use of derivatives in the past year, since market was very volatile, especially equity markets, we do hope that the regulators can recognize the precise use of, let's say, equity derivatives or some interest rate derivatives, and gave us a bit more concrete description of how these derivatives can be reflected on the capital treatment. Because we envisage this type of usage of derivatives will increase going forward as market still presents with a lot of uncertainties.
Thank you very much, Chun-yen. And everyone, that concludes our Q&A with Chun-yen Liu, Chief Investment Officer of AIA Singapore. Thank you so much for tuning in.
Thank you.